All right, apologize, guys. So thank God I remembered that. So yeah, feel free to email or give us a phone call. We'll be happy to answer any sort of questions or concerns if you have. If you have a client that needs a question asked, if you have a question that you want asked, if you're just curious, hey, if you even have your own estate plan that you need to take care of, feel free to enter into contact with us. We like to be very, very available. We don't bill like, 0.1 hour for a 5-minute phone call. We don't do anything of that sort. All right, so let's get into it. So as I said, before we start delving into really like what the issues are with foreign buyers and foreign sellers and the pitfalls, it's kind of important to just get a few basic ideas here out of the way and classification. So the tax code, everyone is terrified of it, and rightfully so. The tax code is ludicrously complicated. It's got ridiculous amounts of parts and subparts to those subparts. And it makes people terrified. It makes lawyers terrified, to be honest with you. I got a lot of lawyers that don't even want to touch any sort of tax issue. But in this respect, when we're talking about foreign buyers, it's actually fairly remarkably simple. So as complex can be for FIRPTA and U.S. estate and gift tax purposes, which is really the main issues that we're dealing with foreign buyers and foreign sellers, there's just 3 basic classifications. And we're going to go into more detail with them as we go along. First one is U.S. persons, right? U.S. persons. Second one is non-resident aliens. And the third is really just for U.S. estate and gift tax issues only, and it's called non-citizen domiciliaries, right? So let's get into the first one. So U.S. persons, what's a U.S. person? Well, basically, right at the top of the list is obviously U.S. citizens. Probably most of you are familiar that if you are a U.S. citizen, then you are subject to income tax on your worldwide income, no matter if you live in the United States or not. Vast majority of countries have what we call a territorial tax jurisdiction system, where if you're not a resident of that country, even if you're a citizen, you're not subject to the income tax laws of that country. Not for the United States. The United States says if you're a U.S. citizen, to keep that privilege of U.S. citizenship, you have to pay your U.S. income taxes wherever you are in the entire world, even if you've never lived in the United States before, right? The second one is green card holders. They're pretty much treated the same as U.S. citizens in terms of income tax, FIRPTA, what have you not. And you'll see it later on. So the benefit of U.S. green card holders, even if they've lived outside of the country for a long period of time, and some do, even though they're technically meant to be living here permanently, for FIRPTA purposes, they're still considered U.S. persons because they're still considered U.S. persons for income tax purposes. They also always have to file an income tax return. Third one, U.S. corporations. U.S. corporations are always U.S. persons, right? New York Corporation, Delaware Corporation, Florida Corporation. Doesn't matter if all the directors, all the officers, all the shareholders are foreign persons. If it's a U.S. domestic corporation organized here in the United States, it's a U.S. person for income tax and FIRPTA purposes. Next one, U.S. partnerships. U.S. partnerships, LPs, LLPs, you're probably going to deal mostly with LLCs more than anything. That's a bit of a hybrid between corporations and partnerships. But LLCs, same thing, same type of thing, where LLCs are a very unique beast in that tax beast, in that if there is one foreign person, just one foreign member controlling the LLC, then it is a foreign person for income tax and FIRPTA purposes. If there are 2 members in the LLC, then it is actually considered domestic partnership, and it is a U.S. person for tax purposes, right? And I'll get into that a little bit more later, because it can give some planning opportunities in order to avoid FIRPTA withholding in the future. And then the last but not least is this thing called the substantial presence test. You may or may not have heard about it. But the substantial presence test is basically, and this catches so many foreign individuals that aren't either green card holders or citizens. They think, okay, well, I'm here on a temporary visa, I'm just visiting, I'm on a visitor visa, I'm really a resident of another country, doesn't matter. In the substantial presence test is saying that if you exceed 183 days of physical presence in the US in 1 calendar year, for that calendar year, you're considered an income taxpayer in the United States, just like a citizen, just like a green card holder. Again, could have some benefits to FERPTA for a lot of people that it applies to. We're talking about high net worth individuals, very wealthy individuals. It could be really, really a crushing blow because they have so many assets around the world. All of a sudden, those assets for that year are going to be subject to income tax. So we always tell our clients to be very careful with that. The test, by the way, this formula is very complex. It's 183 days. They take a third of the days of the previous year, a sixth of the days of 2 years before that. So just as a general rule, we say as long as someone isn't physically present in the United States for more than 120 days on any calendar year, they will not pass the substantial presence test. So they'll be safe from that. All right. There are a few exceptions to that, by the way. You might have had clients that are like students, they're on an F visa, they're on a J visa, they're diplomats. Those very narrow categories are exempt from the substantial presence test. So you can be a student here for up to 5 years and not be subject to those rules. Let's see here. So yeah, if any of the conditions apply, then the person's U.S. tax resident, just like a U.S. citizen. They owe taxes on any worldwide income. They have to report it. They're subject to reporting. So, and there's big, huge penalties for failing to even just report. So they really have to stay on top of that. They have to stay on top of their days. Important thing as well is you may get clients, and we get this all the time, your foreign clients. You know, you might just raise the issue of like, oh, you're spending a lot of time here. Maybe you should talk to an attorney. Obviously, you guys aren't expected to know all this stuff. It's just to kind of see you guys be able to see the red flags so that you could help your clients, right? You can show them that you know what you know more than just the very, very basics of what's needed for a deal. And some clients are going to tell you, oh, no, well, it's okay. I mean, I spend a lot of time here, but due to COVID, I was forced to stay here, or oh, I file a tax return in my home country, so there's no requirement to file it here. Doesn't matter. U.S. government doesn't care if you file a tax return. If you pass a substantial presence test, if you're a green card holder, if you're a U.S. citizen, you have to file a U.S. income tax return. You have to report. The U.S. government doesn't care, and they don't send out any letters to these foreigners saying, hey, you passed 183 days, we're expecting a tax return. They're presumed to be to know the law and then have to be in compliance, right? So if you the bottom line is, if you have a client that is spending an inordinate amount of time here, they're not a diplomat, they're not a foreign student, then it's best to just recommend, hey, you probably should talk to an accountant or attorney, someone licensed, in order to determine if you have any tax filing obligations. Doesn't matter if they're filing in their home country. All right, doesn't matter. We've got this. I think I've had 3 clients this year already. They try to convince me, and I'm just sitting there, and I was like, you know, I know the rules better than you in the U.S., so you can't convince me. And last but not least, never assume anything, right? The clients, they assume so many things. They assume because of COVID, they assume because they're filing tax returns. They just make these assumptions without really looking into it. So tell a client, don't assume anything, all right? Especially U.S. taxes. We all know that way too well, dealing with the IRS. 2, non-resident alien definition. What is a non-resident alien? Okay, so basically any non-U.S. citizen, non-green card holding individual who does not pass the substantial presence test. So that applies to individuals, right? So you could even have an H-1B visa, for instance, a work visa or something like that. But if for instance, and we have clients like this, they have an H-1B visa, but they spend only part of the time in the US, and a lot of the time they spend in their home country. They're constantly going back and forth, sometimes intra-company transferee visa, right? So if they're spending a lot of time in their country, obviously any salary that they're receiving from a US company, from US sources, that's going to be subject to income tax, right? But not necessarily their worldwide income, worldwide assets, right? Second one is foreign trusts. Foreign trusts is a very complicated term. I'm not going to get into this. There's a couple of tests under the Internal Revenue Code you have to pass to determine whether a trust is considered foreign or domestic. The bottom line is, if a very easy test is if there's any trustee that's a foreigner, that's a non-US person, like an Irish citizen, Brazilian citizen, what have you not, it's a foreign trust automatically, right, under US law. Third one is foreign corporations, entities. So, you know, as domestic corporations are US persons, foreign corporations and entities are non-US persons for income tax and FERPTA purposes. We're talking about British Virgin Island companies, Bahamas companies, Canadian companies, what have you not, depending on where they're incorporated, where they're organized. where they're existing, where they're essentially registered. And then lastly, of course, foreign partnerships as well. The most common one we tend to deal with is Ontario limited partnerships. We love those. We form those a lot for our Mexican and for our European clients. And again, that's considered a foreign person for income tax purposes and FERPA as well. Last but not least, U.S. domiciliary. If you're trying to keep up with this, and don't worry, we're not testing you on this. We're going to send a copy of the presentation. Relax. No one's going to give you a test on the U.S. tax code. All right. That's something we definitely don't want to do. We're here to help you guys. All right. You can review it if you want later on. Call us, ask questions just to get you. Again, this is just for you guys to be able to spot the red flags. U.S. domiciliary. This is important for U.S. estate and gift tax purposes. It's a subjective criteria, and we hate that as attorneys. I hate subjective criteria. That makes our job so much more difficult. It's so nice to have an objective criteria where, where 183 days done. As much as I hate the substantial presence test, at least it gives us a specific idea of what's going on here. Not so much with what we call U.S. domiciliary. So basically, what does this mean? It's a rule that only applies to non-U.S. citizens. It's really a rule that applies for U.S. estate tax purposes. And why is this so important, especially in the context of U.S. real estate, which we're going to go into later? This is important because U.S. real estate under the U.S. tax code is considered a U.S. situs asset, right? Which is subject to U.S. estate tax. And it's the same thing for co-op shares. Co-op shares are the shares of essentially of a domestic corporation, and upon death, that is considered a taxable asset for U.S. estate tax purposes. So you might have heard a lot of things going around about death taxes, things like that. Luckily, if you're a U.S. citizen or you're a U.S. domiciliary, non-citizen domiciliary, you have an exemption. Each individual has an exemption currently set at $11.7 million. If your estate is under $11.7 million, you pay zero U.S. estate tax. If your estate is over $11.7 million, and God bless you if that's your case, that's a great problem to have. Most of us don't have that problem, but anything above $11.7 million is taxed at 40% of fair market value. That's going to be the U.S. estate tax. Same thing for gift tax as well during lifetime. Any transfers above $11.7 million, subject to that gift tax. There are some updates here. This is going to be a topic for another webinar. They're trying to lower the exemption in January to 6 million. I don't think it's going to happen. They don't have the votes for it. But anyhow, we have the $11.7 million exemption as U.S. persons, right? U.S. citizens, I'm sorry. U.S. citizens have that exemption. But if you're a non-citizen, you can only have that exemption of $11.7 million if you're actually domiciled here. Right? Domiciled subjective test. You could be here for 1 day and be considered a domiciliary. It all depends on what your intentions are to stay here long term. You could be a green card holder, had a green card for 20 years, but then have considered abandon your residency because you spent way too much time in your foreign country, in your home country, in a house there, you're voting there, everything's there, right? So it's a very nebulous concept for pretty much any non-citizen, right? There's no guarantee that just because you have a green card, you're going to get that $11.7 million exemption. So if you don't have that exemption, right? If you don't qualify as a citizen or a non-US domiciliary, what is your exemption? $60,000. That's all they have. If you're a non-citizen, non-domiciliary, your exemption is only $60,000. Anything above $60,000 of US situs assets is subject to estate tax. And why is that such a problem? It's such a problem because, as you may know, you're probably familiar, you're dealing in a market like New York, dealing in a market like Miami, and people purchase real estate that's worth far more money than $60,000, right? And if they purchase it in their own name, if they purchase it in a domestic corporation where they hold the shares, if they purchase it, then they could potentially be liable for a really hefty estate tax. And even worse, if they purchase it in the name of several people. This is very common. They put son, daughter, what have you not on the deed as like joint tenancy of right of survivorship, what we call, the poor man's estate planning, essentially. They could be considered as having given a completed gift for U.S. gift tax purposes if that person did not contribute any funds to that real estate. So it's really, really crucial to get these issues way ahead of time and way before closing, way before that deed is actually signed and recorded, because after that point in time, it gets very difficult to change. So I just kind of fast forwarded here because I think I spent a little too much time on the U.S. tax definitions. But this slide here, this is basically something I just went over about the. It says 11.7, 11.5. It's actually 11.7. 11.5 was last year. It's always adjusted for inflation. So this is just for you guys. We're going to be sending a copy of this to all of you afterwards, so that you don't have to feverishly write notes as I'm talking, right? You can look at this later on. So this slide here, U.S. real estate ownership risks and income tax, the balancing act. So this, again, don't have to know it. You don't have to learn it by heart or anything. I put this slide here really to just demonstrate the different tax treatments between U.S. entities and foreign entities and purchasing and such. And I put this in here because a lot of times we get clients that come to us and foreign buyers, and they say, well, you know, I had a friend that purchased it in a British Virgin Islands company. I'm just going to do the same thing. And or I had a friend that just purchased it in an LLC, and I'm just going to do the same thing. You know, every client has different objectives. Every client has different requirements. Maybe it's for rental, maybe it's for personal use, maybe it's for long-term appreciation, maybe it's a flip. They're purchasing like a new construction, right? And they don't intend to hold it for a very long time. So there's so many different there's so many different questions we have to ask for these clients, right? Of course, we ask these questions all the time. We deal with it. We deal with Allison. Allison does a lot of closings. We keep in touch with the team, and then Allison makes sure the deal's going through, all the contracts. We make sure that if necessary to create a trust or a structure, that that's being created at the same time the client's aware about it, and so we keep things moving. One thing that I want to stress with this, though, is there's not one size fits all. It's a balancing act. When you're trying to mitigate the risks of U.S. estate or gift tax, you're typically increasing the income tax obligations of the structure, right? There's not a perfect, there isn't like a perfect structure for foreign persons. So we always have to be very careful of that, because sometimes when a client decides to just buy like in a BVI company or something like that, it might blow up in their face later on. Maybe they end up getting a huge tax bill with branch profit taxes and things like that that they weren't going to be aware of. So bear that in mind. Okay. Again, you're not expected to know any of this. It's just to show that it's not the easiest thing. It's not just a simple matter of just throwing it into a company or a trust or something like that and done. So what are the common holding structures, right? If your client is potentially looking down the barrel of a big U.S. estate tax, and they're concerned about it, and they want to figure out, okay, then what's the strategy here? Well, I'm just putting out some very common holding structures that we make with our clients. And by the way, these are actually very, I'm not going to say straightforward. That's completely the wrong word. But they're actually very fast to make. Don't be alarmed by these things as brokers. We completely understand your side. You need to keep that deal pushed along. We want to keep the deal going along too, right? Typically, it's in the client. Obviously, we've got to protect our client's interest, but 99% of the time, it's in everyone's best interest to keep this deal going along, right? We're working towards a common goal here. So, and these structures are not time consuming to make. We're not talking about a month or even 2 weeks. We're talking probably a week at most, right, to form these. So even a couple of days if necessary, right, if it's super urgent. So the first one, I'm always going to mention this, is holding an individual name. Of course, this creates a U.S. estate tax issue, because if they die with the real estate directly, U.S. real estate with co-op shares directly in their own name. So it's the most efficient for U.S. income tax purposes. You have to sell it, realize some sort of gain or loss, then that is perhaps the best structure, right? It's the most income tax efficient, least efficient for estate and gift tax purposes. Having said that, we do sometimes recommend this, right? Because sometimes if it's a relatively low level asset, right? Let's say, for instance, they're purchasing a co-op for $450,000, $500,000, something along those lines, and they live here, and it's going to be their primary domicile, but maybe not forever because they're a foreigner and an H-1B visa. We have a client like that right now, and they're going to go back to their country. Then, does it really make sense to create a foreign entity with a New York corporation or something along those lines and a trust, right? And pay all these maintenance fees and go with the formalities? Probably not. Right. One thing that we hate to do is we hate to oversell. We don't oversell to our clients, right? If we feel like even if we can make a lot of money out of it, that's absolutely something we do not do, right? We always want to make our clients comfortable with the and fully informed about their options, right? So if it's like a $500,000 co-op, it's probably best to just leave in their name, especially if they intend to live in it, right? At least for the short term, they still get the star exemption there. Yes, could they be subject to U.S. Estate tax if they die? Probably, if they're not considered domiciled here. But at the same time, what we tend to do is in those situations, they tend to be younger, healthier. So we tend to say, look, get an insurance policy, get a whole life policy, something along those lines. At least get it if you're young and you can keep the and you can keep the premiums low for the rest of your life, or a 20, 30-year term policy, at least some sort of policy. So if you die, then that policy can end up paying any estate tax owed, which is really great as well, because another problem is with estate tax, it's owed within 9 months of death. That's another big issue too. So a life insurance policy will pay out very, very fast. But if you have an estate tax bill of up to 40% of the fair market value of the asset, right, and you have no liquidity, and we've dealt with clients like this, they're going to be looking down the barrel of a fire sale, right? And they're probably not going to get the best price for it because they're going to have to sell it in order to get the funds to pay the estate tax. Second one is holding directly in an irrevocable trust that avoids U.S. estate tax. And this is a little actually more income tax efficient than traditional like corporate structure, because basically a trust, not so great with income tax if the trust doesn't distribute, very compressed income tax brackets, but very efficient for long-term capital gains if they hold the real estate for more than 1 year. It can also qualify for potentially for IRC 121 treatment, which is exemption for capital gains. Long-term capital gains up to $250,000 per person, $500,000 for a couple, and it can also qualify for star exemption as well. Having said that, trusts can be tricky, right? Again, I come back to this term of like not one size does not fit all. With foreign buyers, you always have to look at two sides of the equation, not just the US side, but the home country. Some countries recognize trusts, and so it's not an issue for them. But a transfer to a trust, just like it would be for a US person, might incur gift tax in their home country. We have to double check that to make sure. Some countries have that, some countries don't. Portugal, for instance, doesn't have any gift or estate tax, so it's not an issue with Portuguese citizens. However, some countries like Germany, for instance, just do not. It's a terrible idea generally for Germans to have irrevocable trusts because it gets very, very complex into the German tax code. So it's really on a case-by-case basis. The third holding structure that we tend to do is holding directly in a foreign entity, right? British Virgin Islands Company, like I just mentioned. And then holding the real estate. This is a great way because of, in terms of avoiding U.S. estate tax, because by putting it in the foreign entity, it's what we call a foreign blocker. So when the person passes away, they don't pass away holding directly the real estate. They are holding foreign company shares, which isn't subject to U.S. estate tax, right? So it avoids U.S. estate tax issue. However, one thing we don't like about it, which isn't too efficient, is when it comes to sale, right? A foreign entity is still considered a foreign person for income and FIRPTA purposes, right? So something we tend to do is the last structure, which is holding in the name of a U.S. corporation wholly owned by the foreign entity. What's the benefit of this? The benefit is there are certain income tax benefits that avoids a double taxation issue on sale. It still gets depreciation deduction. So if there's rental income, then it's still not going to be taxable income, avoids a double taxation issue. And best of all, especially for foreign buyers, for foreign sellers, is they're holding it in the name of a U.S. corporation, then there's no FIRPTA withholding, right? Which FIRPTA honestly is the biggest elephant in the room whenever we're dealing with foreign sellers. Another point, planning must be done. I think I just mentioned this before. Planning must be done before closing. Once deeded into client's individual name, it becomes difficult and costly to restructure. Foreign owners will not be able to gift any interest in real estate or additional parties to deed without incurring U.S. gift tax, or unless that party purchases something from them, right? And we've seen that again. And that could be very tricky. We had one client that came to us. He had deeded his daughter. They were all non-citizens on U.S. real estate, and we caught it just in time. The daughter actually has a 9-month period to what we call disclaim the gift, which is what we did. We took her off the deed, no U.S. gift tax issue. After that 9 months, you don't get the disclaimer anymore. So then there's a potential for U.S. gift tax. Foreign owner that adds person to deed, sorry, I just mentioned this. A transfer to a trust would be difficult, right? So let's say, for instance, it's buying their individual name. They decide, okay, well, I want to do an irrevocable trust to avoid estate tax, and it's not an issue in my home country, and it also provides for succession planning. Great, but how are we going to transfer that real estate in there without incurring a gift tax, right? Gift tax is taxed the same way as the state. If you gift that to the trust, which most of them want to do, then you're going to incur U.S. gift tax. There's an exemption there for co-op shares, but co-ops are very notoriously difficult. Co-ops almost never allow irrevocable trusts. So usually what happens in that case, either they have to sell it to the trust, usually on an installment sale, very complicated. And if FIRPTA is involved, we have to get a certificate of withholding, takes forever, costs, things like that. They have to recognize any gain. It's a mess, it turns into a mess for them. Last but not least, same thing, transfer to a foreign entity. If any of you are ever familiar with capitalizing your own companies, you might be familiar that for a US person that transfers property to their own company, a domestic company, there's no realization of gain. You're just essentially transferring that for your benefit to start a business or something. It just inherits the basis. Not so with foreign corporations. If you transfer US real estate to a foreign entity, that's like a corporation, which we typically use for these kind of structures, the client's going to have to realize gain. There's going to still be a FIRPTA withholding, even though it's essentially a phantom income here. It's a phantom sale. So now I just want to get into some FIRPTA rules real fast. Hopefully I haven't overwhelmed you guys with so much information. Just say I do see the chats, I do see the Q&As that are populating here. I just want to try to be efficient here. I'll answer those as soon as the presentation done. It's almost over. So FIRPTA rules. So I think if you're if you're a real estate professional, you've probably heard of it. We certainly have. What is FIRPTA? It stands for Foreign Investment Real Property Tax Act from 1981. Really kind of changed the field in terms of foreign buyers with foreign sellers. It applies whenever a foreign non-US person transfers a US real property interest. Why do I say that? Sounds like a very technical term, because it just doesn't mean if they recognize oh, I didn't recognize a gain, so it's not subject to me. Oh, I'm only transferring corporate shares. Oh, it's a very, very, very broad definition, right? So we always have to watch out. We're always keeping an eye on things when a non-US person, a foreign individual under FIRPTA is looking to transfer some sort of US real estate interest. The withholding requirements for individual non-US transfers, 15% of the sale price. So if the sale price is $1 million, FIRPTA withholding is $150,000, right? That has to be sent to the IRS. It's important to note for foreign sellers that withholding is not the tax owed. It's the mechanism to ensure the IRS receives payment of that tax, right? If they actually recognize a loss, then they can file a tax return the following year and then request a refund of that FIRPTA withholding, saying, look, I recognize a loss, give me my money back. And the IRS will eventually, in their own sweet time, give the refund back. Withholding must be sent to IRS within 20 days of closing to avoid penalties, right? They give a very tight turnaround here. They don't mess around with this. And the buyer has liability for any unpaid tax and penalties if there's a failure to withhold or timely send in withholding. Why is that? The whole point of FERPTA is they didn't want this mechanism is they didn't want the foreign seller to take the money and run, right? And then the IRS not be able to catch up with them, get to foreign bank accounts. What they do, they put the onus on the buyer, whoever the buyer is, whether it's a US person or foreigner. Because the buyer, after the closing, has US real estate that they can put slap a lien on if the tax is never paid, right? So buyers take this very seriously. There are some exceptions to mandatory 50% withholding, right? There's obviously the most common one you might have heard is non-foreign affidavit, only applies if the seller is a US person, right? So it's US citizen, green card holder, US corporation, US LLC with more than 2 members, someone that's got substantially present in the US that calendar year of the sale, then they could sign off on a non-foreign affidavit, and then it wouldn't be an issue. That's the most common exception, right? The second one is primary residence and low value property. So the primary residence low value is essentially if there is if the property is being sold for no more than $300,000 and it's intended to be the primary residence of the buyer, then FERPTA withholding isn't required. It's a pretty rare exception, especially in the New York market. It's very rare to find real estate in New York City, for instance, Miami, Florida, which we tend to deal with for $300,000 or less. If you find it, please let me know. I'd be really, really interested in some potential real estate investment. The third one is 8288B, certificate of withholding. What is this? Don't want to get into too details, but basically, yes. So the default rule is you have a 15% withholding that must be sent to the IRS if it's a foreign seller. There is an exception to this. You can ask the IRS for permission to have that lowered or eliminated, right? And that can be based on the fact that the seller is going to recognize a loss. They're actually not going to owe tax, right? Back in the pre-pandemic days, this was very, very common to do. I'd do it for almost all my foreign sellers. You would file the certificate, you file the supporting documentation. The IRS would, the monies were typically kept in escrow after closing with an escrow FERPTA escrow agreement. So it wasn't sent to the IRS. So you didn't have to, it wasn't sent to this black hole of the IRS that then you'd have to get a refund like months and months and months and months later. Then the IRS typically took 90 days to respond to this. And then once they get the certificate reducing or eliminating it, then the escrow agent would release the funds in 90 days, which wasn't so bad pre-pandemic. It was great. I mean, it satisfied all parties. Right now, though, it's a mess. The IRS is an absolute mess. It's a disaster. The FERPTA office was shut down essentially for a year in 2020. They just had certificate withholding applications accumulating and accumulating. And now it's taken from 90 days, it's gone to almost a year, from 9 months to 12 months. And they're still working through this backlog. We can't even get simple things like EIN numbers for our clients. It takes forever. So the bottom line is what I say about this certificate of withholding. If the closing is happening at the very end of the year, like right around now, probably best not to do it. I would just have the money sent to the IRS, and then the foreign buyer files a tax return in January, February asking for a refund. Doesn't mean that they're going to get it immediately. The IRS still takes forever to give refunds, but that's probably going to be faster than certificate of withholding. If a closing is happening in the beginning of the year, let's say for instance, closing happening January 1st, certificate of withholding makes sense because the foreign buyer won't be able to file a tax return for a year, right? So up until the January of the following year. So certificate of withholding in that case makes more sense, right? Unfortunately, there's no perfect solution here. We're dealing with just these backlogs. The foreign sellers are getting really frustrated by it. We try to give them their options the best we can, but there's no perfect solution. There's no fast solution. That's for sure. We're dealing with an IRS, and they were not terribly efficient even before the pandemic, and now it's just forget it. Last point I want to make here on this slide: 1031 exchange is not a valid exception to withholding. I see this all the time. Oh, but I'm going to use the funds for 1031 exchange. Doesn't matter. FERPTA withholding is still required regardless, or a certificate of withholding or an exception to FERPTA that I just mentioned here. 1031. So clients say, well, what happens then? That 15%, I was going to use it to purchase a qualifying property. How do you handle it? The only way you're really going to handle it at this point, I tell clients, is they're selling a property for $1 million and there's $150,000 withholding. The only way really efficiently to handle it in a timely manner is for the client to take $150,000 of their own funds, right, from savings or brokerage or what have you not, if they have it, and then put it in escrow to satisfy the FERPTA withholding. And the funds that they get from the sale, right, those are going to be the qualifying funds. They can use 100% of that. And it just, for lack of a better word, it sucks. I mean, it's just terrible for the client. It's essentially a really, it's not a great choice, right? But that's the world we live in right now, unfortunately. Hopefully they're going to have the backlog sorted out. I'm not sure, hopefully next year, but who knows, the IRS. I think I already went through these. Oh, we have just some common issues here. 300K, the exception to FERPTA. If it's 300K, the buyer still has to confirm that they're going to use it as their primary residence. We always protect our clients and the withholding agent with some sort of affidavit saying that, yes, I am going to use it as my primary residence. This typically works better with co-ops. Co-ops typically want people as their using it as their primary residence, and co-ops typically don't like rentals or anything like that. And A288B early refund exceptions, I just explained that. This is what I just mentioned before. I don't want to spend too much time on it. It's the whole mechanism approach. This is more for when we send out this presentation. If you guys just want some details about certificate of withholding application, it's right here. And yeah, some other points to make about certificate of withholding. There's some drawbacks I just want to mention. IRS has full discretion to reject the application, right? So this goes back to my point that I made, that if it's at the end of the year, it's probably best to just send the money in and file a refund, because what happens if the client's waiting for up to 12 months, certificate of withholding, guess what? The IRS can, in their discretion, just reject it outright for no good reason whatsoever. And they have done this in the past. Usually by error, but there's no appeal process. Once you get that rejection letter, you have the client has to send in the money to the IRS, and then they have to ask for the refund during the regular way anyway. So through the income tax return. So it is kind of there's a lot of strategy involved here, especially end of year. I wouldn't assume to just do a certificate of withholding right now if I was the client. Some potential strategies to avoid FERPTA withholding. As I mentioned before, the client can purchase a multi-level corporate holding structure. That's with that foreign corporation that owns a New York corporation that then owns the real estate. The U.S. corporation is not a U.S. person. Purchase utilizing a U.S. partnership entity, for instance, like a limited partnership or even an LLC of more than one member. One strategy that I do is, if there's a client that has an LLC and they're the sole owner of the LLC, FERPTA applies. But say, for instance, hey, have you ever considered putting your wife in as a 1% member and you as a 99%? Once that is done, it turns into a domestic partnership, not subject to FERPTA 2. However, bear in mind that just doing this right before closing probably isn't going to work. It needs to, it kind of needs planning ahead of time, because the other side might just see it for what it is, which is just to avoid FERPTA, and they might not agree to it and wants to do withholding anyway. Another way is purchase in the name of a U.S. domestic trust. It would need a U.S. trustee. That could be any individual, could be a friend of the family or something. It doesn't have to be a bank or anything like that. Trusts don't have to be terribly expensive. U.S. domestic trust can work just as well. It's a U.S. person, but there's no rental income coming in. There's no issue, right? There's no income to report. So, and then last but not least, if real estate is owned by a foreign company, they can consider selling the shares of the foreign company. So selling shares, transferring the shares of a foreign company, might be subject to like a state tax, transfer taxes, but not to FERPTA. Right, it's exempt from FERPTA. And I put here just like Tony Blair, because Pandora Papers came out recently. Tony Blair and Sherry Blair, former Prime Minister of Great Britain, of the UK, they purchased some real estate in London, but they purchased the shares of a BVI company. The seller actually didn't want to sell the real estate outright. They wanted to sell the BVI company shares. To their credit, Tony and Sherry actually were like, they really didn't want to do that, probably because they were going to see how ugly it would be for them to just even be owning shares for an offshore company. But they purchased it, and it avoided like a local transfer tax. And of course, this came out in the Pandora Papers, huge scandal anyway, even though they didn't end up owning it. But yeah, you could do that here too. You could transfer they can transfer the shares of BVI, Bahamas company, and then wouldn't be subject to FERPTA. There's a bunch of issues there because then they won't realize they'd have to give credit for built-in gains, the income tax. Nobody wants to buy company shares, especially a BVI company, especially if you're a US person. So it really only works if it's very close family members, very close associates, that kind of thing. Otherwise, just forget it. And that's the end of the presentation. So obligatory disclaimer, this is not legal advice. This is informational purposes here. Everything might not be accurate. Everything might be up to date, blah, blah, blah. Take it as is. Not your attorneys, but would love to be yours or your client's attorneys. Get in touch with us if you have any questions. We'll be happy to answer them. And let me just go in here because we have 10 in chat and 2 in Q&A. So I'm going to start in the Q&A. Karen asks, do foreign owners of co-ops individually owned need to file annual income taxes? Karen, they do not need to file annual income tax individually owned unless they're receiving rental income from that co-op, right? Any rental income from U.S. real estate is subject to U.S. estate taxes. In that case, if they're not residing here, they would file what's called a 1040 NR, which is a 1040 non-resident tax return to declare that. So yeah, they don't need to file it to income tax rate so long as it's in their individual name. Let's go to the chats here. It's like good mornings. Down. So Adriana, so not 183 days, 120 for substantial presence. So Adriana, yeah. Adriana, just to clarify, it's just because 183 days, it's not in one calendar year. You could actually be less than 183 days in the calendar year. But if you spent a certain amount of time, but then what they do is they take all the days. So let's say, I'll give you an example. For 2021, to determine whether a U.S. person passes the substantial presence test 2021, the IRS is going to take all the days that they spent in 2021, the calendar year of 2021, January 1st to December 31st, 2021. Then they're going to take a third of the days that they spent in the US in 2020. And then they're going to take a sixth of the days that that person spent in 2019. Then they're going to add all those up. If it passes, if all that adds up to 183 days or more, then they pass substantial presence test in a U.S. person, right? So, but the bottom line is we tell clients that 120 days, just sort of no more than 120 days every year, kind of like, so when you do the math, take all the days, the 128 days from 2021, then a third of the days from 2020 of those 120 days, and then a sixth of the days from 2019 of those 120 days. It's not going to add up. It'll probably add up, I think, just to like 181 days. And more questions here. Yes, subject to formula. My 10th right view says so it can be an exception to go. Yes, Arturo, you're right. 90 days, like I said, was the standard turnaround time pre-pandemic. Now it's taking a heck of a lot longer, right? It's definitely not 90 days now. Hopefully it'll get back to 90 days soon, but definitely not now. Risk of boot, so it is risky, you're right. I won't get into boot though, that's a little, I think we're running out of time here. Is primary residence, another question, Miriam Lopez. Is primary residence requirement for seller or buyer when looking at exceptions to 50%? No, primary residence has nothing to do with it, Miriam. Exceptions to 15% withholding, FERPTA only applies if you're a foreign person, right? So if you're not a US citizen, not a green card holder, and are not spending so much time here that you pass the substantial presence test in the year of sale, then you're a foreign seller. Having said that, if it's someone's primary residence in that they live there all the time, they probably pass the substantial presence test. But primary residence has nothing to do with it. There's no exception for that. Another question from Patty Cadena. Of that 15% withholding, how much typically is returned back to seller? I assume it depends on the case, but average, what do they get back? Or they simply don't count with any refund at all? Patty, it really depends on how much tax they owed. So if they actually incur a loss on the sale, they're entitled to get the full 100% back. If, for instance, let's just do our example for $1 million property, $150,000 withholding, but their tax liability, they only made a very small profit on that, net gain on that. Then they'll get the difference, whatever it is. So if they only owed, for instance, $50,000 of income tax at the end of the day, then they'll get a refund of $100,000. It's a really case-by-case basis. James, that was wonderful. Thank you. Thank you so much, James. I really appreciate that. And Adriana said, thanks. So I think that's all. Let me just double check Q&A here. So Karen, is it possible to restructure the ownership from individual to these offshore platforms after the fact? Again, co-op. Yes, Karen, it is possible, and we do that for clients. It's just more complex after post-closing because we have to deal with FERPDA. But it is possible, absolutely is possible. But they absolutely should not do it by themselves. They need to talk to someone that's experienced and knows what they're doing. Otherwise, they could end up with a huge tax bill. Again, co-op for co-ops, though, I will say co-ops are not the foreign buyer and seller's friend. That's why a lot of foreign buyers tend to avoid co-ops because co-ops don't like, first of all, they prohibit LLCs owning it. They pretty much prohibit corporations owning the shares. I've only ever had one client where the co-op accepted to have the co-op shares held in a New York corporation. And that client had been living in that building for like 50 years and was like one of the founding residents or something like that. So that was more of an exception to the rule. Co-ops typically allow revocable trusts, but those are tax neutral. They won't really benefit a client. The only thing, one really great strategy for co-ops, Karen, would be an irrevocable trust, because whereas someone holding the shares of a co-op is subject to estate tax at death, they're not subject to gift tax if they transfer it during their life. It's just one of these odd disconnects in the tax law. So if the co-op allows it, they can create an irrevocable trust that's not subject to U.S. estate tax, and then transfer the co-op shares U.S. gift tax free. Of course, we have to look at their their home country, see if there's going to be gift tax there. Having said that, co-ops are starting to come around to the terms of trust. They really are, but they're still very difficult with them, especially with irrevocable trust. They're just, I try to explain to co-ops a million times, look, estate planning, here's the strategy, here's the law. They don't care. They just think the client is trying to go through the back door of having a million relatives go and walk into the apartment and use it and trash the building. That's all they're thinking in their mind. Hopefully that changes in the future. That becomes less and less common, but co-ops are still pretty hesitant with trusts, especially irrevocable trusts. But it's always good. You look, never assume anything. Always ask. We always ask the co-op, right? And some of them can pleasantly surprise you. Where else? I'm sorry, I got lost here. Is it possible to restructure? Yes. So Arturo Shivers, what about partial reductions of withholding via A2A? Yeah, Arturo, yes, you can partially reduce it. You're absolutely right. You can reduce it. Part of the A288B application is either to reduce or eliminate the withholding. So if you can demonstrate to the IRS that your tax is actually, it's $150,000 withholding, but you actually only owe $20,000 in income taxes on the sale, then the IRS can reduce that to $20,000. So yeah, that's part of the process as well. We do that all the time too. So what ends up happening is they just end up sending a letter instead of, reducing it to 0, they reduce it to 20,000. give that to the withholding agent. Withholding agent releases everything except the 20,000, sends the 20,000 to the IRS, right? Again, issues in the process, backlogs and things like that. Marcos Cohen, my Brazilian foreign seller. Oh, we love Brazilians, Marcos. Me and Toledo, we're both Brazilian. Eu falo português e a Thalita também, né? Seria prazer te conhecer if you speak Portuguese. My Brazilian foreign seller has a $1 million co-op that she has paid 160K in her name. She's 76 years old. Should she put it in trust? Too expensive? Any suggestions, Marcus? No, actually, a trust could be very straightforward. It's not necessarily expensive. Yeah, wow. That's, first of all, great investment, right? I'm sure she's held it for years and years and years. She could put it in trust, but she could put it in trust to avoid estate tax. It depends on whether the co-op will actually allow it to be transferred to an irrevocable trust that's not subject to US estate tax. So it depends. We'd have to touch base with the co-op. Just be careful though, because in Brazil, you have what's called the ITCMD estadual, which is the state gift and transfer tax. So gifts during lifetime, and my colleague Toledo would be better able to be better able to answer this. And I'm actually going to ask to unmute, like, for both of them. I don't know if they're able to, but yeah, they should be careful with ITCMD estadual in Brazil, because in Brazil it's
yes, during lifetime, gifts made during lifetime, it's going to be subject to ITCMD. So we have to be careful on that.
Yeah, but reach out to us if you like. We'll be happy to have free consultation on this. Be happy to answer any more questions about this. And no, trust is not expensive. Yeah, and I think those are just thank yous. Let me just double check chats. I think Karen, you mentioned the state tax needs to be paid in X days in the event of a death. How many days is that? It's not days, it's months. It's 9 months from the date of death it has to be paid. Otherwise, it begins incurring late payment penalties and interest. All right. One thing I always tell people, clients regardless, even if you don't have the money to pay, file the estate tax return. Don't send a check, but file it, because the biggest penalty that you can possibly incur is a late filing penalty, right? I had a client like this a year ago. We were waiting on letters from the surrogates court, took forever, said file it anyway. So we had a late payment penalty, but we didn't have the late filing penalty. So it substantially reduced it. Thank you so much, Karen. I really appreciate this. I think that's all we have time for. Again, if you have any further questions, feel free to reach out to me and my colleagues. Allison here, she's a great brain in terms of closings and things like this. My sincere apologies, Talita and Allison. I thought you could unmute by yourself.
No, Chris, you did a great job.
So sorry, guys.
You were amused here watching you talk.
I just thought I was giving all the answers. I was just doing such a great job that you guys didn't need to chime in. So I'm really, really sorry, guys. But they're a great resource too. So we'll leave it at that. And a recording, link to this recording will be sent out to everyone, together with a copy of the presentation in PDF format too.
Great. We have one last question here for Arturo. No, we are not licensed in California, but I'm sure we can refer something.
Yeah, I have California attorneys we can recommend, Arturo. I'm licensed in New York, New Jersey, and Florida. All right, just on the East Coast, unfortunately. All right, but I will be happy to try to help regardless. All right. Thank you very much, everyone. Take care.
Everyone. Bye-bye. Have a good day. Bye.